Hello, this is Rick Ratchford with AmazingAccuracy.com, and I would like to thank you for watching my video. Um, Today I'm going to be talking about the British pound, and I just want to kind of go over a few things that hopefully will give you a little insight on looking for short-term trends so that you can trade with the trend, which is highly advisable. Here's the weekly chart where each bar represents a trading week, and when I refer to any one of these price bars, I refer to its Friday date. So in this case, this bottom that you see here occurred week ending 315, so 315 would have been the end of the week. Now, as you can see, there's these red diamonds, and what that basically is, what they are is F dates, it's just short for future dates, turn dates that are forecasted in advance and published weekly on our F date report. And I just have visual representations here. And we just look for these turns to occur within one bar of the F date, which you can see occurred here. Now, another thing, too, to support the F date and to also get an indication of what the market is likely to do is I have a couple of indicators here. I have the Williams Percent R, and I have the MACD here. Now, usually when the percent R goes into an oversold situation, such as you see here, and here, and also recently here, this is an alert that you really want to start looking for the possibility of a significant bottom in the market. But as you can see in this situation here, where it came in here and then came out again, you would have thought, okay, we should have started to trend up, but that was not the case here. And I'm going to show you why you don't want to use an indicator such as this by itself, but yet in support of it, I would use the MACD, for example. If you'll notice on the MACD, how when we had the signal line crossing down, and they were both the oscillator and signal line are coming below the zero line here. Notice that as these two lines start to spread apart, they create these negative red bars here, and they become taller and taller and taller until they make this upside down peak here. So I don't want to call it a valley, but an inverted peak maybe. But if you'll notice here, it's been coming deep below the zero line. We have strong bear move in the market here, and then all of a sudden it follows. It's this bottom peak here, inverted peak is followed by a shorter, a red line. So it's starting to turn more bullish here, and you'll notice that that's occurring right at the very bottom here. And it's also occurring right around the time where this makes the second dip and then comes out again. So this supported this, whereas this did not support this. So here it's just kept going down, but here it's starting to go up, and it's in support of this. And the F date is also within one bar. We have a lot of indication here that there is an important bottom, and as you can see, it's already confirmed as a swing bottom, and it's already gone almost 2 weeks now. Here's the first week it went higher, this week it went higher, and so we can see that it's already forming this weekly bottom here. If you go back, for example, you'll see it the other time back here where it had moved into the oversold and came out. And the nice thing about it is that it was supported by the MACD. It's not a real strong, like this is real strong, because look how deep that is, and it's so deep down here too as well, and then over here it's not too bad. But these are pretty shallow, but still these are deep, and it was supported here, and that turned out to be a major bottom, and that was week ending 6/1 of 2012, as the market continued up well until September of last year. Notice again here, for example, we went down into the oversold area here, and then it was followed. Came out of there, started going up. It was also followed by the shorter red bar. And so in this case it supported this, so that was also a thing. And if back then, for example, we were expecting a weekly swing bottom with our F dates, you have a complete package of indications here that that's a serious bottom forming here. Again, we can see here that it went into oversold, and we can also see, now notice that when it went to oversold, it was right here. It came out here, for example, but then the next week went lower again. Well, if you'll notice, when it came out here, it wasn't yet supported here, but it was supported here. See where it started to the red bar started to get shorter, and that was saying, yes, this here we can take seriously, whereas this one here, we had no indication whether to take it seriously. So again, we do that here. You notice it went into the oversold and it came out, but yet it did so, and look, it hadn't quite finished its bottom because the bottom is way over here. But yet, if you not only take this coming out, but you'll wait for this confirmation here where you see where the bar gets a little shorter, then you can take that a lot more serious than when it was back here and it was still making these lower bars here. The plus things too to remember is that when you're dealing with these negative red bars, the best ones are when your oscillator and signal lines are also below the zero line along with it, like in the case here and in the case here, for example, and also here. But here it's above. You see these two lines are above the zero. So although we have this confirmation, we can see that it came down and make this bottom, it's not what we would normally consider more of a major bottom than what has occurred, for example, here, where it continued up, or the fact that this is a major bottom and that prices never did go below it, and yet we were dealing with a situation where the two lines are below the zero. So I tend to favor that for when I'm looking at bottoms. I like to see the lines below there too, because it just gives me more of a warm, fuzzy feeling. Now, tops are just the opposite, of course, so, just apply the same thing. The line goes up here for the percent R in the overbought area. You can see it's kind of coming out here, and then you want to see that supported here, and it is. You can see the green line got shorter here. Here's the peak itself, and it's the very top and whatever. Now, what to do with this information is that this dictates to me what direction I should be focusing on in the lower time frame, and in my case that would be the daily time frame. So in this case, since the weekly is showing bullish in that it's coming out of this bottom here, it was forecasted and also supported by the indicators here on the daily chart, and we'll go there. As I'm looking for short-term turns, you can see I have my short-term F dates here. This one here marked the bottom. This one here marked that top, and this one here just marked this new bottom here. And so if prices start rising again, then I would expect that this one would mark the top, and so forth and so on. After we've looked at the weekly, we note that it's on a new bullish move up. I'm more interested in dealing with bottoms to buy, and I'm not interested in tops to sell, okay, because I want to be with the trend. So although we have an F date pinpointing a bottom, an F date pinpointing a top, another one bottom, and so on, it's the ones pinpointing the bottom that provide me with trading opportunities to get in with the trend. The F dates pointing to the opposing turns, in this case the tops, does not provide me with an opportunity to trade with the trend. It just basically lets me know that there's a very good probability the market is going to start moving against my position until it turns again, as it did in this case, for the next short-term turn. So that's how the short-term F dates are used, in that the ones that support going with the trend become part of our buy setup pattern. The ones that are for the that show the opposing turns are not used for entry. You can basically ignore them, or you could just kind of note them if you've already made a very good move and you just don't want to sit in the trade as it's making an opposing move against you. You're warned by the opposing F date that you're likely going to have that happen, so maybe you want to start trailing your stop a little tighter and so forth. And just as we did on the weekly, we can certainly do on the daily. However, the daily chart's a little more all over the place as far as the percent are. In this case, you'll notice that it's bounced and oversold, bounced out, bounced back in, so forth, because there's a lot more noise going on in the lower time frame. But you would definitely then want to support whatever you see here with your MACD, and in this case here we have the cross up where it goes from red to green on the short term, which provides a very good indicator to go along with your percent R and your F dates, if again it's supported by the weekly chart that we have just covered. So you can see here it's gone from bearish to bullish, which coincides with our bottom here and our weekly chart bottom. Here we can see that it went from green to red, okay, and at that time coinciding with the very top that formed in this market. And on the weekly chart, it would coincide with the weekly top. Here we can see that it went from bottom to red to greenish here again, following this oversold here, moving up, and that's the support for this move that went up before it reached this very top. So it's a matter of understanding how to use your indicators and your turn dates for the different time frames. When I'm dealing with my daily here, I like the crossovers to go and give me, especially if I see this kind of noise, to give me my supportive information to go along with my F dates. But on a weekly chart, that one I can just go for my inverted peaks and my peaks, as opposed to waiting for crossovers, because you'll miss a whole chunk of a daily trend waiting for this on a weekly chart, doing the crossover thing here. So it's just a matter of understanding the strength and weaknesses of your indicators and how to apply them to the different time frames. Well, I hope you've learned something from this video. And by the way, you know that by looking at that weekly chart that we should overall be bullish right now in the British pound. Although you see the daily chart here is showing all this green and coming down now, you might go, well, I think it's going to go down more, but the weekly chart says otherwise, and that's the longer time frame. That's the one that dictates the overall trend, and until that starts to go back to a bearish stance, right now it's in a bullish stance. I would advise that you concentrate on the bullish side of the British pound for now, and don't let these counter moves shake you off too easily. Just keep looking for opportunities to buy the higher swing bottoms that form, such as here and here. And if you have use of F dates, then that's a definite plus for you in your precision timing. Thanks again for watching my video. If you haven't done so already, please subscribe to my YouTube channel so you don't miss any future videos, training or forecast videos. And I do have a free email newsletter at amazingaccuracy.com, and also you may want to take advantage of a really fantastic market forecasting book that we offer, and it's just had nothing but rave reviews, and We're in the second year of offering this book, and we still have copies if you're interested as of 3/28/2013. So you definitely want to get that in your hands because it is extremely unique and powerful. Thanks again for watching.